Hey everyone, and welcome! As your expert tutor for the ACCA Financial Management exam, today we are tackling syllabus areas G1 and G2. We're getting right into the weeds of macroeconomic risks. In this explainer, we are breaking down Chapter 17, which is all about risk management. You know, if you've ever felt completely overwhelmed by how massive global forces can just casually wipe out a company's bottom line, well, you're in the right place. We are going to dissect these concepts so you understand them inside and out.
Okay, so here is our roadmap for today's explainer to give you total command over the dual threats of currency and interest rate volatility. We'll be covering 1. The 3 foreign currency risks. 2. Exchange rate macro theories. 3. The 2 interest rate risks. And 4. Interest rate structures.
Let's kick things off with Section 1, 3 foreign currency risks. We're going to start by exploring the very real, practical business risks associated with foreign currency exposure. Because honestly, the second a business crosses a border to buy or sell something, it invites risk.
To make sense of it all, we can actually divide the whole currency risk universe into a really practical taxonomy of 3 distinct operational threats. We've got transaction risk, translation risk, and economic risk. Keeping these separated in your mind is absolutely crucial, because they strike a business at completely different times and in completely different ways. Let's define that first one, transaction risk. This is a short-term cash flow impact. It happens because of exchange rate movements that occur right between the date you agree to a transaction and the date you actually settle it. Imagine you agree to buy some supplies from Europe today, right? But you don't actually have to pay the invoice for 30 days. Well, if the exchange rate shifts negatively during that 1 month, the actual physical cash leaving your bank account could be way higher than you originally planned for. Boom! It immediately eats right into your profit margins. So this is the everyday, pressing threat to your daily sales and short-term cash flows.
Now, what's really fascinating about translation risk is how different it is from that. It's actually an end-of-year accounting and consolidation issue, rather than an immediate cash flow problem. You aren't losing physical cash out of the bank today. But let's say you're translating the value of your overseas branches back into your home currency for your annual report. If the currency dropped, suddenly your overall balance sheet is going to look substantially weaker to your investors. And sure, it doesn't hurt your daily cash balance, but a weak balance sheet could actually cause you to breach debt covenants with your lenders. And believe me, that is a massive headache for any financial manager.
And finally, we have economic risk. This one is driven by prolonged exchange rate shifts. The absolute crucial point here is that economic risk is by far the deepest threat of the 3. It literally has the power to permanently alter your global market position. Say your home currency becomes incredibly strong, and it just stays that way for years. Suddenly, your exports become way too expensive for the rest of the world to afford. This isn't just a tiny accounting hiccup or one bad transaction, it's a structural threat to your entire business model. And definitely remember this for your exam, it is also the absolute hardest risk to hedge against. Because it's a long-term structural shift, you can't just buy a simple 30-day forward contract to patch it up. You may literally have to relocate production or completely pivot your target markets just to survive.
Moving right along to Section 2, exchange rate macro theories. Let's see how all of this builds into the underlying macroeconomic causes of those fluctuations. I mean, why do these rates even move in the first place?
Well, to forecast where currency values are heading, financial managers heavily rely on what we call parity theories to predict future spot exchange rates. To really master this syllabus area, you need to firmly grasp the 2 foundational parity theories. Think of these as the mathematical engines that try to forecast where a currency will land, which is exactly what allows a business to plan its global strategy.
The core difference here really comes down to the underlying metrics driving them. On one hand, we have purchasing power parity theory, or PPP theory, which adjusts based on differing inflation rates. On the other hand, we have interest rate parity theory, IRPT theory, which focuses strictly on interest rate differentials. So, PPPT essentially says that exchange rates will adjust so that a standard basket of goods costs the same in 2 different countries, basically leveling out their different inflation rates over time. It's kind of like a long-term equalizer. Now, IRPT predicts that the currency of a country with a higher interest rate is going to depreciate. Why? To prevent investors from making risk-free arbitrage profits. If one country is offering this massive interest rate, its currency has to weaken in the forward market, otherwise investors would just exploit it like an infinite money loop. So, practically speaking, managers look at PPPT to gauge long-term real exchange rate trends, but they lean heavily on IRPT to calculate short-term forward rates. It's basically a tug-of-war between inflation metrics and interest metrics.
All right, Section 3, 2 interest rate risks. Now that we've conquered currency, let's look at our second major category. Because borrowing money has its very own set of hidden dangers that can completely unravel a perfectly good balance sheet.
The first danger is gap exposure. Simply put, this is a timing problem between your interest-bearing assets and your debt obligations. Let's say you've got a loan where the interest rate adjusts every single month, but the income you get from your investments only adjusts once a year. Right there, you have a massive timing gap. If rates suddenly spike, your debt instantly gets way more expensive, but your income stays totally flat for the rest of the year. That gap on the timeline, that is exactly where your profit disappears. It's a critical duration mismatch that financial managers have to monitor constantly.
Next up is basis risk. This is a super unpredictable scenario where the rates on your different financial instruments start to drift apart even though you totally expected them to stay correlated. You might honestly think your variable rate loan and your variable rate investment are perfectly synced up. But what if one is tied to a central bank base rate and the other is tied to a commercial interbank rate? During a financial crisis, those two underlying benchmarks can actually move at entirely different speeds, so your perfect hedge, it instantly falls apart. That is basis risk in action. The very real danger that two things you thought were identical are actually operating on slightly different rules.
That brings us to Section 4, Interest Rate Structures. Finally, we need to identify the theoretical structures that explain exactly how interest rates behave over time.
So there are 4 distinct interest rate structures that you absolutely need to commit to memory for your exam revision. They are yield curves, expectations theory, liquidity preference theory, and market segmentation. Let's explore each one so we can understand how the market prices the cost of borrowing over different timelines. First up, yield curves. These act as our foundational visual map. They plot out the relationship between interest rates and the time left to maturity. If you imagine a simple graph, your horizontal axis is time, so 1 year, 5 years, 10 years out, and your vertical axis is the interest rate. By connecting the dots across that graph, you get a curve that instantly tells you whether short-term or long-term borrowing is more expensive right now. It is the absolute baseline tool for every major financial decision a company makes regarding its debt.
Next, we have expectations theory. This theory argues that the actual shape of that yield curve is simply the market's best guess of what future interest rates will be. So if the yield curve slopes sharply upwards, it means investors collectively expect interest rates to go up in the future. It operates under the assumption that the curve is basically the market's aggregated crystal ball, just reflecting the combined forecasts of millions of financial participants all at once.
Then we move to liquidity preference theory. This theory builds on the previous one, but it adds a necessary risk premium to compensate investors for tying up their capital over longer periods. It basically injects a heavy dose of human psychology into all the math. Look, people generally prefer to keep their cash liquid and accessible for emergencies, right? So if you want them to lock their money away in a 10-year bond, you have to pay them extra to give up that flexibility. That required extra payment is what we call the liquidity premium.
Alternatively, we have market segmentation theory. This one suggests that we should treat different maturities as completely disconnected markets that have their own unique forces of supply and demand. In this view, the retail banks buying short-term 30-day debt and the massive pension funds buying 30-year government bonds, they don't even really interact. The rates for short-term and long-term debt are set completely independently by the participants isolated in those specific segments. They're technically playing on the same field, but they're playing entirely different games.
And that brings us to our final thought for this explainer. Which of these dual threats actually poses the greatest risk to your balance sheet? Based on the frameworks we just went through, I want you to ask yourself whether a business is more vulnerable to sudden, massive currency shifts or to unexpected interest rate gaps in the year ahead. Understanding these concepts, it isn't just about passing the ACCA financial management exam, it's about learning how to safeguard real-world value against wildly unpredictable global forces. Thank you so much for joining me today. Definitely keep these frameworks in mind and happy studying.